There are some special rules for cash basis taxpayers. Remember, cash basis, you record revenue when you receive cash. However, you can constructively receive income, which is the idea that you didn't get the cash, but you basically got the cash, or you had the right to the cash or access to the cash. In that case, that is still going to be taxable gross income. Let's keep moving down through the chapter. Original issue discount is not a big topic that I expect you to know a lot about. Whoops. Amounts received, yeah, under obligation to repay. So that's borrowed funds, basically. That is not taxable. You have to pay it back. You don't get to keep it. Um, there's some special rules for accrual basis taxpayers as well, specifically with regard to prepaid income. So you receive money in advance. And there's some basic ideas here for if you receive advance payments for goods, and then if you receive advance payments for providing of services. If you receive advance payments for providing of goods, you can defer recognition of income for tax purposes just the same as you would for book or financial statement purposes. If you don't provide the goods for book purposes, then you don't record the revenue. You've got a liability to perform the revenue, liability to perform the service, and the same thing applies for tax. So as long as you defer for financial purposes, you can defer for tax. However, in this area down here, deferral for advance payment for services, the idea is that if you get money for providing of services that you're going to provide, let's say over the next few years, then the government will let you only recognize income for tax that you earn this year in the year of receipt instead of paying tax on all the money you receive. But then it makes you pay tax on the rest of the payment you received in the next year. So if you have a 4-year contract, for book purposes, you're just going to record revenue as you earn that cash over the whole 4 years. You've set up an unearned revenue, liability account up front when you got the money, and you'll record revenue over 4 years or whatever. For tax purposes, you record what you earn in the first year or year of receipt, but then the rest of it gets picked up into taxable income in the second year. So it's a bit of a difference from GAAP there. Oh, keep in mind, I skipped past this. Keep in mind, though, that advance payments for rent or interest are always taxed in the year of receipt. Just a special little rule there. So if you're a landlord and you collect last month's rent up front, that's going to be taxable in that year of receipt. So there's some examples there for you. Planning strategies, personal services. So just read kind of this idea. You can't assign income to somebody else. If you earn it, you're going to pay tax on it. Keep moving through. Income from property, meaning if you own property that produces income, whoever owns the property has to pay tax on the income. That kind of thing is true of interest and dividends. There's a good discussion here on dividends and the idea that if you're in a tax bracket, one of these rates, and you receive dividend income, that dividend is going to be subject to 15% tax rate, so you get a benefit. If your tax rate is already at 10 or 15%, so it's sufficiently low, then you don't pay any tax on qualified dividends. And this goes on to discuss what qualified dividends are. Keep moving through this. There's some good examples there. Income received by an agent. If your agent gets paid, then basically you're getting paid. So you can't have somebody else receive your cash and expect to not have to pay tax on it. Learning Objective 4 gets into, this is talking about specific items of gross income now, and I think I'm going to pick this up in the next video.